So I invest only into ETFs, and in an ideal world, I would invest into just one ETF that will give me exposure to everything so that I don't have to worry about buying separate funds. So in this video, I'm going to look at some of the most popular all-world ETFs on Trading 212 to see if there is an ultimate ETF for people like me that just want to invest into just one fund. So as you can see, this is my Trading 212 Stocks and Shares ISA. I've grown this portfolio solely just by investing into ETFs. And my thing has always been to, search for different ETFs. Sometimes I'm invested into something like the All World, and then I sell it, and then I'm sometimes invested into the S&P 500. I like that because I have one fund, I can just sell it whenever I want and then just buy another one. And it allows me to change strategies and not keep any loyalty to any one fund provider for any reason. Although I don't really recommend that, and everyone knows that long-term investing is probably going to be your best bet for getting all those gains in the future. Personally, I've done that and I am happy with that. So if you would like to sign up to Trading 212 and receive a free fractional share worth up to £100, all you have to do is to click the link in the description box down below. Alternatively, if you've already signed up to Trading 212 in the past 10 days but have not received your free fractional share, all you have to do is to click the 3 horizontal line menu over here, scroll all the way down until you see this section, use promo code, and in this menu just enter my code JUBAIR and you should receive a free fractional share. But anyway, let's use my Stocks and Shares ISA to look at some of the most popular all-world funds. Let's see what they're invested into, let's see what their costs are, and let's just see if there is actually one ETF that will make me happy for the rest of my life if I was just invested into that. So here we are on Trading 212 search menu. Let's just type in all world. Now, if you already know the ticker code to the investment that you want, then obviously you can just do that. But let's go with all world as Trading 212 is going to give us the most popular options. There's a new fund here that I want to talk about that is kind of becoming more and more popular as it has the lowest fees. But let's go into the most popular one first, which is by Vanguard. And you can see this is called the VWRP. Now, essentially there are two versions of this, the VWRP and then the VWRL down here. They're almost exactly the same, but one reinvests any dividends paid out by investing into the companies of the fund back into the fund, and then one distributes them. So let's go to the first one. So this is the Vanguard FTSE All World, and this is an accumulating fund, which means that the dividends are reaccumulated back into the fund. Now, I'm not going to be comparing performance figures in this video as they could always change. Let's actually focus on what it's invested into and what the fees are. Also, as I'm scrolling, the Trading 212 AI analysis feature is becoming more prominent. They've started to talk about this a lot more, but yeah, I made a separate video on that. So the Vanguard FTSE All World is very popular. Just because something is popular never means that it's the best option. This is with everything. For example, the iPhone is not objectively the best phone in the world. However, it is the most popular and it gets most of the things that the people want done. So the first important figure when looking at different ETFs is of course the expense ratio. Now this fund has an expense ratio of 0.22%, which in my opinion is actually really low for a world fund. You have to think not too long ago, something like this that will give you exposure to many of the world's markets would have cost a lot more, closer to 1 to 2%, because you might have had to go through someone specific for that. However, these days, you may notice that there is fierce competition in the ETF landscape. It used to be dominated by just Vanguard, but there are new players in the game that can offer the same or very similar thing for a lot cheaper. Now, it's worth mentioning that the higher the ongoing charge is, more of your portfolio will be eroded to these fees. Although these fees do not come out of your balance, they are taken out of the value of the fund. So the higher these fees are, the less of a return you're going to get on the value of your investment. Another important figure might be the assets under management. This is a relatively large fund with £14.5 billion in it, which is pretty good. Now, the important part for me is the fund allocation. Now, we can actually go through company to company, but I think, the better thing would be to look at the distribution of countries. But we can see anyway, the top 3 holdings are all holdings that are found in the S&P 500. For example, Apple, Microsoft, and Nvidia, which tells me automatically that this has a very high weighting weighting towards the US. Now, normally sectors is not something that I really look at because there might be some overlap in these sectors, for example, technology and financials. But as long as you see that there are a number of different sectors, then you know that you might be quite well diversified across different sectors. You know, it's not 100% just financials or 100% just technology. Now, when we go into the country distribution, we can see, yes, of course, it's about 63% of a weighting in terms of its holding in the United States of America, which again will be almost solely the S&P 500. Now we can see because this is an all world, it does have, a concentration to other economies around the world. For example, Japan at around 5.8%. which is not too bad. The United Kingdom about 3.5%, China again around 3.5%, France at nearly 2.5%, Canada, we have Germany, Switzerland, India. India is a good one to see because it is the second most populous country in the world, if not closing in on the most populous country in the entire world. Going forward, it's not, unreasonable to expect China and India to be bigger players in the game. So it's nice to see that, there is some holding in China and India, although, collectively it's still less than 10%, which is realistically a very small amount. But we do have Taiwan, and then we have other, which of course is not explained here. Now, the VWRP could be a decent option for someone beginning to invest, because it does have a good amount of concentration in the United States of America, which, why wouldn't you want to have that? Because the United States has historically given the most returns. But going with an all-world ETF instead of making your own portfolio could be beneficial because in the future, Vanguard could choose to increase the amount of holding, weighting towards Japan, UK, China, as and if, let's say, the US starts to perform less and less, which is possible, but it is also very possible that the United States of America just continues to grow and grow. Nothing is out of the question here. So overall, the Vanguard FTSE All World gives you basically a bit of everything with a huge weighting towards the US, and it gives you this for 0.22%. So what are our other options? Now, if I had to choose an all world fund, it probably wouldn't be Vanguard. I actually probably would go with the Invesco FTSE All World. I have actually invested into this fund before prior to selling out and buying the iShares S&P 500. Like I said, with my ETF strategy, it's nice that I have only one fund which I can sell out and then reassess my situation and then use that cash to buy a different fund. For example, I can go from an all world to an S&P 500, something I cannot recommend to anyone else. Again, this is my personal journey. This is not financial advice. But if you asked me a month ago which one I would go for, I would probably have said this one, the FWRG. Now, this is the Invesco FTSE All World. Again, this is an accumulating fund. One good thing about accumulating funds is that there's not much management required. You just buy a fund and then you just leave it there. Of course, you can do whatever you want with your cash and investments. I'm just saying, that's one way to look at it. So unfortunately, Trading 212 has not got complete information about this fund. So we're going to have to use just ETF. So here we are, the information about the FWRG, the Invesco FTSE All World. The first thing we note is that the total expense ratio is 0.15%. And you may be thinking to yourself that it's not actually a huge deal. It's not that much cheaper. However, when you do the math, this is about 30% cheaper than the Vanguard FTSE All World. Now, I'm happy that there are more fund providers out there because it gives competition. And it's unlikely that, this fund provider is going to then increase its fees, because if it does, then Vanguard would become more competitive. So it's nice that all of these fund providers are, increasing the competition and bringing our prices down. Now, one thing to note about these funds, for example, the Invesco FTSE All World, is that they are considerably newer. This one has been around for just under 2 years, so there's not a lot of data to support its performance. But also, people might be hesitant to put money into a brand new ETF because if the ETF is not popular, then it could actually just be axed, and then, you could potentially lose some money there if you had to sell early. Now, in terms of assets under management, this is not the smallest fund in the world. It has around £1 billion in assets under management, which is actually pretty good for less than 2 years. If you think about it, the Vanguard FTSE All World has been around for a tad longer, and it's around 14 times the size of this. Now, importantly, let's talk about what holdings we get with the Invesco FTSE All World. Now, the top 3 companies tells us quite a bit about this fund. You can see Apple now is at 4.2%, Microsoft at 3.6%, and then Nvidia about 3.28%. We can immediately see that there is a smaller weighting towards the United States of America. Now, when we go into the breakdown of the countries, we can see that it is around a 60% weighting towards the USA. Now, that's only down from about 62% from the Vanguard FTSE All World. But remember, there are differences between each fund and how they track the S&P 500. So even with a 2% difference there, we can see that the top company does seem to have gone down a lot compared to the Vanguard FTSE All World. So with this fund, you get a 60% weighting towards the United States of America. You get around 6% in Japan, about 3.5% in the UK, and you can see China is the next one at 3%. Then we have Switzerland, France, Germany, Canada, Taiwan, and other. Unfortunately, the breakdown into India cannot be seen here. It most likely is with other, but there is no actual mention of India. So through doing my own research, I can see that it is about a 1.98% weighting towards India. Obviously, these numbers can change. So I actually would prefer to have a higher weighting towards these economies such as China and India, not because necessarily I have any sort of favoritism towards them, but I just think given the growth of the GDP in their economies is going to be a larger world player, and of course the immense size of the populations, the two combined nearly account for 3 billion people. Now, if we look at the sectors, we can see we have a distribution of different sectors. For example, technology, financials, consumer discretionary, industrials, healthcare, telecommunications, and the list goes on. So we see that, of course, because it's invested mostly into something like the S&P 500, and then we have, the UK markets and the Chinese markets and Switzerland markets, it is not just focused into one sector. So like I said before, the FWRG would probably have been the one that I would want to invest into because it's cheaper than the Vanguard FTSE All World and has a slightly lower weighting towards the United States of America. If for whatever reason you still wanted a higher weighting towards the US, what you could do is to buy a separate S&P 500 fund. And, by all means, do that if you want to. So in my last video, someone actually mentioned that there is a new fund that is actually cheaper than both of these, and I really want to explore that in this video. So this is by SPDR, and as you can see, this is called the SPDR or SPDR MSCI All Country World UCITS Accumulating Fund. So this is the SPDR MSCI All Country World UCITS Accumulating Fund. Obviously, accumulating meaning that the dividends are reinvested back into the fund. You can also see from related pies that Tom from Tom's Personal Finance also has this in one of his pies. You can go check his channel out and also his pie if you want. Unfortunately, again, Trading 212 does not have the full details for this fund, so we're going to have to use just ETF again. So here are the fund details for the SPDR MSCI All Country World UCITS ETF Accumulating Fund. What a mouthful here. But you can see the main thing is that the total expense ratio is 0.12%, which is almost half the price of the Vanguard FTSE All World. So it's definitely a whole lot cheaper. Every decimal point could make a difference in the long term, even if it's a few hundred or £1,000. So this fund actually tracks large and mid-cap stocks from 23 developed and 24 emerging markets. So in theory, that will be nice exposure over the world's different markets. Now, the fund size in comparison to the Vanguard FTSE All World is going to be smaller. So this stands at 3 billion compared to about 14 billion with the Vanguard FTSE All World. So it definitely isn't as popular of a fund as the Vanguard FTSE All World. Remember, like I said before, just because something is popular does not mean that it's always the best choice. So let's pop into holdings. You can see this is again a very similar story here. It's not going to be less than 50% US. We have 4.39% in Apple. The next big holding is Nvidia instead of Microsoft. Remember, each fund provider, whether it's iShares, whether it's Invesco, or even SPDR, they're going to, track the S&P 500 in subtly different ways. So here is the breakdown in terms of countries. We have 61.6% US, so very similar to the Vanguard FTSE All World. We have around nearly 5% in Japan, so that is a bit higher here. 3.5-ish% in the UK. We have China at around 3%. We have Canada, Switzerland, France, Germany, and we also have India at around 1.7%. Again, a very, very small holding towards India. But that being said, even though China is the second largest economy in the world and India is following behind somewhere around there, investing into so-called emerging markets comes with a greater risk, especially when the US, at least on paper, is giving most of the return. That's why I do understand why there isn't such heavy focus towards these economies. And the other thing is emerging markets can grow at a much faster rate than developed economies, for example, the US and the UK, because how much more can you grow when you're already so large? But with developing nations, there is a possibility that it can grow more. There's also a possibility that it can collapse more, and that's why maybe the weighting is not so high towards there. So the last one we are going to look at, just for the sake of comparison, is iShares. So this fund is the iShares Core MSCI World Accumulating Fund. Again, all of these funds I talked about today and this fund are all in either pound or pence sterling. So as a UK investor, there's no extra foreign exchange fee, although there will be foreign exchange because these are investing into foreign markets, but you're just not going to have to pay that. So as you can see, this fund has a total expense ratio of 0.2%, making it cheaper than the Vanguard FTSE All World. And it's also a lot larger at 80.12 billion. Now that's considerably larger than the Vanguard FTSE All World. Now when we go into fund allocation, we can see Nvidia is the top company here, which is different, 4.67% there. Microsoft being the second largest at around 4.5%. And then Apple at around 4%. Now, in terms of countries, this fund has an even higher weighting towards the United States of America at around 71.2%. And then it is Japan at around 5.4%. And then UK, Canada, France, Germany, Switzerland, and no mention of India, although the other in the other section is only 4.75%. So I would assume just from this that the India concentration would be pretty low. In fact, I also do notice that there is China missing from here, which is the second largest economy in the world. So I probably wouldn't go for this fund just because it is missing out a decent amount of China plus India. But as I explained to you before, there is a reason as to why these fund managers don't include those countries. So make sure to check out some of my other videos and I'll see you in the next video.